Good morning. This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda. Global stocks hit a record after US inflation data fuels bets on a Fed cut next month. The Treasury Secretary says 50 basis points should be in play. Scott Bessent also rules out the possibility that Chinese investment in the US could be part of any trade pact. We will speak to the US Treasury Secretary later today. And Ukraine's President Volodymyr Zelenskiy says he will not cede the Donbas region to Russia as he pushes to be included in Friday's talks between Washington and Moscow. Happy Wednesday. So yes, global stocks at fresh record highs. We saw gains of more than 1% for both the Nasdaq and the S&P 500, fueled by those in-line inflation print, of course, that came in 1:30 p.m. UK time, and the pull forward in terms of expectations around the Fed and September now firmly in play, almost 100% priced in by the markets. European stocks then on the front foot on the back of that story, up 0.4%. The FTSE 100 here in the UK looking to add 21 points. S&P futures looking flat after the gains of yesterday. On hold maybe for the next data print, the key one, retail sales data out of the US on Friday. Nasdaq 100 futures again punching through those fresh record highs yesterday, looking to add just 17 points so far as we look at the futures story there. Cross asset, let's flip the board. The US 10-year in focus. The front end, of course, the steep curvening in the terms of the yield curve steepening story continues, it seems, with continued concerns about the deficit in the US, but the fall forward in terms of expectations around Fed cuts, of course, in terms of September, and the Fed, the Treasury Secretary, I should say, putting in play, it seems, the possibility of a jumbo cut, hinting at that, at least, Scott Bessent, in terms of 50 basis points and suggesting that should be considered. 420 rate right now on the US 10-year. Not a lot of movement across the curve so far today. Euro dollar at 116. A little stronger for the single currency, just up 0.1%. Brent crude at $66 a barrel, up 0.2%. And gold, the yellow metal, currently gaining just 0.1%. Let's check in on how the Asian markets are faring. A focus on Taiwan, a focus again on Japan. Min low in Hong Kong with a check on those markets. Min.
Hey, Tom, it's a very broad-based rally here in Asia. You can see a sea of green, the Asia-Pacific index up by 1.1%. And this gain is being led by the Nikkei 225 once again, 1.36% today after the record high yesterday. This is the sixth consecutive session of gains on the Nikkei 225. The TAIEX already flirting with record highs. The Kospi just 3% away from all-time highs. And you look at China as well. Onshore, the Shanghai Composite has erased the losses since the peak of 2021. It's at a 4-year high now, and we're seeing this quiet resurgence of interest in the Chinese stock market, right, because of the liquidity conditions there. We can flip the board, please. And also we have household investors putting more money into stocks given the low interest rate environment there. We're also watching the consumer sector very closely today because this morning the Chinese government held a press conference introducing a big stimulus. We're talking about consumer loan subsidies for interest payments. Flip the board, please. We have, the government announcing 3,000 yuan in loan cap per person. This applies to big ticket items in the sectors of autos, education and healthcare, and of course small ticket items below 50,000 yuan. So here you can see Hefei department store up 10%, Alibaba up by 3% as well. We're looking at the tech sector in China as well because Tencent is set to report today. We're expecting to hear a double-digit increase in its revenue for the second quarter, a third consecutive quarter for that. And you see here it's up 3% ahead of earnings. This is an index heavyweight, of course, so it's helping to lift the Hang Seng Tech by about 2.5%. But because Tencent is really very cheap now in terms of valuations if you compare to its peers like Nintendo and Sony, and so there are expectations that we could see Tencent seeing a surge in share prices, hitting historical highs in a matter of time, because if you flip the chart, you can see that we are now trading at 25% below the peak in 2021. But we have been seeing the estimates in terms of earnings at a record high. So still some gap here to catch up. So we could potentially see this share prices rally after the earnings. So we'll be keeping an eye on that. Tom?
OK, watching for Tencent, the details around the owner, of course, of the WeChat app and a major investor, of course, and developer of games as well. So that story out, the details later today amidst this broader risk-on move across these equity markets. Min Min Low in Hong Kong and the gains there in the Asian session as well. Min Min, thank you. The inline reading of the monthly US core CPI then is boosting the bets that the Fed will cut rates soon, with some seeing higher chances of an outsized reduction.
What we see is that inflation creeping over and spilling over from goods into services. And that is an issue for the consumer in terms of, is the consumer now starting to make tougher choices because of the impact of tariffs?
It appears that companies have room as a result of still high margins coming out of the pandemic. Companies have room to sort of more slowly pass this on to consumers.
People say, oh, the retailer's going to eat it. No, they're not. They just wrote the check. So of course it looks like they're eating it. Walmart writes a check, but eventually they're going to pass it on.
It comes one way or the other. It's either going to be corporate margins, which all else equal is a drag on the stock market, or it's going to be in the consumer, which is a drag on the economy, which then feeds through to the stock market.
OK, for more on the market moves, let's bring in Bloomberg's Valerie Teitel. So, Val, for the equity markets, the in-line inflation print of yesterday, even with core ticking up, was rocket fuel for the stock markets.
Yeah, exactly. It really wasn't enough worries about tariff-induced inflation to take the Fed's eye off the weakening labor market, and that is why the equity market boomed into yesterday's close. But taking a closer look at this print, Tom, core CPI month-on-month came bang in line at 0.3%. There was minimal evidence of tariff pass-through to these sectors that we've been looking at, whether it's furniture, audio equipment, or apparel. And it's led to some out there in the market, some economists, especially those at JP Morgan, to revise lower their CPI pass-through expectations from tariffs. All of this led to a pretty solid session when it comes to treasuries. We saw a decent rally in the front end. The market is essentially pricing in that September 25 basis point rate cut as a done deal. And we're already hearing from the likes of Scott Bessent trying to move the goalpost even further, talking about how the Fed should consider a 50 basis point rate reduction. And his argument, they've already should have been cutting if they had those payroll revisions in their back pocket in June and July. We also are seeing some interesting price action and some interesting trades in front end rate futures, those trying to position for a outsized 50 basis point rate cut. But it's likely that we'll pause around this kind of pricing because we do have a lot more data to contend with before the Fed convenes again on the 17th of September. We get another round of jobs reports and CPI before that decision.
OK, so that's breaking down the data for us with great clarity. And then we look ahead, as you say, to retail sales on Friday. Back to the markets, Val, and the reaction. Is this a market now? Is this an equity market that is starting to price in a jumbo cut in September?
It really, what the market is pricing in is just lower implied vols across asset classes. That's what really helped out the equity market yesterday. We saw a drop in the VIX. The VIX actually hit its lowest price all year. Year to date, the VIX is at lows below the 15 handle. But we also saw a drop when it comes to fixed income volatility, when it comes to FX volatility, and this lower implied volatility. That means risk on for the equity market.
Bloomberg's Valerie Teitel, thank you very much indeed. Breaking down the market action, global markets, global stocks at fresh record highs. Treasury Secretary, meanwhile, Scott Bessent, dismissing the possibility that Chinese investments in the US could be part of any trade deal. Of course, we've seen massive investments pledged by many countries that have tied up deals with the US. Asked if China could make similar billion-dollar pledges like Japan, South Korea and the EU as part of their trade agreements, Bessent said critical industries needed to be, quote, reshored away from China. This comes after Trump announced another 90-day pause on Chinese tariffs. I'm joined now by Bloomberg's Kriti Good for the latest. So, Kriti, what is our understanding at a time, of course, when negotiations between the US and China continue? We have that 90-day extension in terms of what this agreement could look like if investments in the US from China are not part of that.
There is so many touch points. There are so many touch points, I should say, when it comes to that relationship. And if you can't talk about actual investment, which has been a consistent concern, not just with China, but you mentioned Japan as well. The Nippon Steel deal has really brought into question how much foreign direct investment you actually want at the end of the day, which is ironic given it's such a key pillar of Donald Trump's policy, bringing in that foreign investment to kind of offset some of the expenditures when it comes to things that the government would need to spend in terms of the country. It's one of the components of U.S. GDP. But the other key touch points are things like rare earths, it's IP, it's technology, but it's also a manufacturing and supply chain story that extends not into China, just into China, but into Vietnam, the Philippines, Malaysia, et cetera, that ultimately comes back to the end consumer. And the point that Scott Bessent is trying to make here is that there's already so much interdependence between the two. Do we need to include foreign direct investment on top of that? Anecdotally, for example, when the Chinese invested in the Empire State Building, just as a hypothetical, that is where there was a lot of concern about the fact that some of these massive American projects are foreign owned. And that was something that domestically caused quite a bit of concern. This was years ago, of course, but it's that kind of sentiment that's starting to come back.
More broadly, in terms of the revenue increase coming through from tariffs, are we any clearer to a point where that is starting to offset concerns about the U.S. deficit? Is it making a mark as we see those revenues tick up year on year pretty substantially?
They're enormous. I mean, the last 3 months, just from the tariff collected since Liberation Day, even as these kind of negotiations are ongoing, are a pretty decent chunk of change. We're talking about billions of dollars being collected by the IRS, but billions doesn't solve a trillion-dollar problem or a multi-trillion-dollar problem. And that's really where the concern is. His argument, or Donald Trump's argument, is simply that the math will add up, that the tariff revenue plus the tax cuts will somehow offset the deficit. But we've talked to economists, to market participants throughout programming who suddenly said, well, the math doesn't add up because you're not actually taking into account some of the other pieces as well. That being said, it's the interest rate payments that are ultimately causing the kind of snowball effect in the deficit. And that's where those kind of essentially Doge cuts were pointed at to kind of get rid of the underlying thing that is ultimately spending the money and then be able to bring the deficit down. We are making a dent, but it's a tiny dent, Tom.
OK, so a tiny dent as those revenues from tariffs tick up. What is your kind of understanding of the inflation dynamics that we're seeing in the US right now? The fact that inline came in, of course, but in terms of core, there was a modest tick up. And Scott Bessent, the Treasury Secretary, he described it as unusual. I'm paraphrasing. I mean, it's something like unusual when it comes to the services part of the inflation story. And then we have the Trump administration again, President Trump taking aim at Goldman Sachs' CEO for getting their call on inflation wrong. And again, that's the take from the president. Who's winning this argument at this point?
I think as there is with any data point, there's something in it for everyone. And I think what's key here is that when you look at the overlying data point, the estimate was 2.8%. 2.8%. It came in at 2.7%, which is a small drop, at least on the nominal level. But it's still kind of bang in line. It's not that much of an improvement when it comes to inflation. And the reason is because the underlying pieces of it, the parts that are ticking up, whether it's oil related, whether it's tariff related, you name it, it's being offset by other pieces. So housing was a big piece of this that has continued to be a downtrend. Oil prices, as they come down, tend to offset some of those increases in prices. So from the kind of net level, it all looks stable, it all looks calm, but the components are moving quite a bit. So from a White House administration perspective, having falling housing prices may actually be a good thing. Having falling oil prices may actually be a good thing because in the end numbers, they offset each other. And from a American consumers' kind of spending basket, that's a positive.
Pretty good, sir. Thank you very much indeed. Anchor, of course, of the opening trade. Now look at some of the other stories we are following this Wednesday. President Trump's pick to lead the Bureau of Labor Statistics, the BLS, has suggested suspending the monthly jobs report and publishing only quarterly numbers. Speaking with Fox News, E.J. Antoni said the Fed could not conduct monetary policy when the monthly report was unreliable and misleading. The White House confirmed Antoni had floated the idea of a suspension, but says it still expects to get a monthly report. President Trump says he's considering a lawsuit against Fed Chair Jerome Powell over cost overruns in the central bank's headquarters renovation. In a Truth Social post, he calls Powell's handling of the project grossly incompetent and damaging to the economy. Trump's also taken aim at Goldman Sachs' CEO, as I mentioned, David Solomon, saying the bank was wrong about the impact of his tariff agenda. Here's what else to think about today then. 7 a.m. UK time, we're going to get CPI out of Germany. So to the inflation story of the US, to the inflation story of Germany. Overall, of course, the Eurozone's price impact pressure is in line with ECB expectations, ECB targets. Of course, we'll get more detail from Germany at 7 a.m. 8 a.m. UK time, meanwhile, it is Spanish inflation. We'll break that for you. And at 9 a.m. UK time, the IEA oil report will come out after more details yesterday from OPEC+. So that will build out the picture in terms of the demand story for oil. You can get a roundup of the stories you need to know to get your day going in today's edition of Daybreak. Terminal subscribers can go to DAYB Go on the terminal And of course, bets around the Fed on the back of that more benign inflation picture is front and centre in terms of the details and reporting today on the Daybreak page. Coming up, another bleak milestone in China's property crisis. Meanwhile, as Evergrande's Hong Kong stock is delisted. We will unpack the firm's downfall next and what it tells us about that crucial real estate sector in China. Plus, later in the show, we're going to get more on how markets are reacting to a cooling of US-India relations and a take as well in terms of that Fed repricing. Stay with us. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Good morning, everyone. Happy Wednesday. Volodymyr Zelenskiy is rejecting Vladimir Putin's demand that Ukraine give up the Donbas region to secure a ceasefire, flagging concern it could later be a bridgehead for a future Russian offensive. Zelenskiy is insisting Kyiv be included in talks ahead of a meeting between US President Donald Trump and Putin in Alaska on Friday. US Secretary of State Marco Rubio, meanwhile, says the summit will help the administration decide whether to keep up economic and military pressure to secure a peace deal. China Evergrande Group says its Hong Kong stock will be delisted more than a year and a half since trading was suspended. Liquidators are also warning that its debt load is much greater than previously feared. It marks the end of an era for the former high-flying developer whose demise has come to symbolise the country's property bust. Let's bring in our China credit reporter, Trista Law. Trista, what does this delisting mean for Evergrande? What does it mean for the property sector of China?
Yeah, thanks, Tom. I think it's a really symbolic moment for China's property sector. As we all know that Evergrande, in some way, the fate of Evergrande actually represents the ups and downs of the whole property sector. Evergrande was once the largest developer by itself in mainland China, and it was worth more than $50 billion at its peak back in 2017. But only 4 years later, in 2021, it defaulted on its dollar bond, and in January last year, it received the liquidation order in Hong Kong court, and the share of Evergrande has been suspended. The trading of its share has been suspended since then. The delisting news actually came within our expectation, because in Hong Kong, after the trading of your share has been suspended for over 18 months, the delisting could come. So, but I think like the delisting will not have much impact on the overall liquidation. But for the shareholder of Evergrande, right now is the official moment that the equity they hold become worthless.
What does it mean in terms of the liquidation story for Evergrande? How much progress do we expect to be made? What are you and the team watching for? And is the fate of Evergrande going to be echoed and mirrored by other major developers in China as they wrestle with similarly high debt levels?
Yes, so as you can imagine, the liquidation is really complicated given the asset size and also the number of creditors. Liquidator actually pointed out the firms actually compromised 300 legal entities in multiple jurisdictions. So that number can give you a sense about how complicated the whole case is. But since the Hong Kong court appointed the liquidator, they have been working so hard and actually realized some asset about up to $250 million. And also they received the control of more than 100 companies related to Evergrande. But it's also the first time we know that the liquidator also pointed out the real, the debt load could be far bigger than what we knew previously, up to $45 billion. So that's the new number. And there are lots of moving factors on this case. And we are watching a lot of trial cases as well. The trial against Evergrande's founder, Hui Ka-yan, will return to Hong Kong court in September. And also, we just published a scoop that the liquidator actually hire banks to sell some of the asset right now. So, Tom, there are a lot of moving parts, and the whole team, as you mentioned, has been following this so close.
OK, thank you for the update. An important update in terms of the fate of Evergrande and what it tells us about the real estate sector of China as home sales there continue to fall as well, more broadly. China credit reporter Trista Law, thank you for that update. Coming up, as the war in Gaza continues, the CEO of the Norwegian Sovereign Wealth Fund explains why they have divested from 11 Israeli companies. That is next. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Now, earlier this week, Norway's $1.9 trillion sovereign wealth fund divested from 11 Israeli companies and terminated all contracts with external managers in Israel. CEO Nicolai Tangen told us the fund is continuously evaluating ethical aspects of its investments.
It's important for us not to be political. We are an investment fund. We have one overriding goal, and it is to make money, of course, within the mandate we have from the ministry. Now, we divested from these Israeli companies, not because they were Israeli, but in this case, because we wanted to simplify the portfolio management we did in Israel. So these were companies which were not in the index, and we decided to take home the asset management. We discontinued 3 external relationships with external managers. And then we decided to do it ourselves, just to kind of simplify what we are doing and how we deal with this.
Are you evaluating at all changes to some of your responsible investment strategy as part of this, Nicolai?
Well, we are continuously evaluating this. We also have a separate entity called the Council of Ethics, which is looking into more, ethical aspects of our investments. And then in terms of being invested in Israel, that's a political question. It's not a decision that we do. So what we do is to make sure that we invest in Israel in a responsible way.
Norges Bank Investment Management CEO Nicolai Tangen speaking with Bloomberg's Danny Berger. Now, some other stories making the news this Wednesday. China's most valuable company reports earnings today, with Tencent expected to deliver its slowest net income growth in more than a year. Investors will be focused on the company's ability to absorb weakening domestic consumption and its plans to boost AI capabilities. Bloomberg Intelligence says it does not expect Tencent to generate significant incremental earnings in AI this year. Meanwhile, AI startup Perplexity has made a formal offer to acquire Google's Chrome browser for almost $35 billion. The offer comes as Google faces US antitrust proceedings that could require it to sell the web browser. An analyst at Robert W. Baird says Perplexity's offer undervalues the asset and should not be taken seriously. Singapore is set to sell an eye-watering variety of luxury items confiscated from money launderers who were convicted in the country's biggest laundering case. Deloitte will manage the process of selling the non-cash assets after police handed over more than 460 pieces of luxury goods and 58 pieces of gold bars. The proceeds from the sale of the seized assets are to be put in a de facto bank account of the Singapore government. Coming up, we're going to speak to Tanvi Kanchan about how the markets are reacting to India-US relations souring and her views on the adjustments in terms of the pull forwards, on bets around the Fed. September firmly in play. What does it mean for the US? What does it mean for the equity story in India? That conversation analysis coming up. This is Bloomberg. Good morning. This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda. Global stocks hit a record after US inflation data fuels bets on a Fed cut next month. The Treasury Secretary says 50 basis points should be in play. Scott Bessent also rules out the possibility that Chinese investment in the US could be part of any trade pact. We will speak to the US Treasury Secretary later today. And Ukraine's President Volodymyr Zelenskiy says he will not cede the Donbas region to Russia as he pushes to be included in Friday's talks between Washington and Moscow. Let's get to the markets then. Record highs again for global stocks. You saw the upside coming through for US equities closing higher by more than 1% for the S&P 500 and the Nasdaq 100 by the end of the close yesterday on in-line inflation. Core ticked up a bit, but for the markets, this was a signal that the Fed has space to go in September and possibly by more than 25 basis points. That is something that the Treasury Secretary, Scott Bessent, is hinting at. European futures then on the front foot, up 0.4% after gains of 0.2 yesterday. FTSE 100 futures looking to add 18 points. S&P futures currently flat after the gains of yesterday. Nasdaq 100 futures pointing up by just 16 points. Let's flip the board and have a look cross asset. US Treasuries, of course, in focus. Retail sales will come through on Friday. That is the next major data point for these US markets. The US 10-year yielding 4.28, largely unchanged in the session today. The euro slightly stronger at 1.16 versus the US dollar. Brent up 0.1% at $66 a barrel, and gold edging modestly higher at $3,350 per troy ounce. Now, the US CPI report showed the cost of tariff-exposed goods did not rise as much as feared, with some investors boosting bets then, as I've mentioned, on an outsized rate cut from the Fed next month. For more on the market impacts, I'm joined by Tanvi Kanchan, Head of Business and Strategy at Anand Rathi Shares and Stock Brokers. Tanvi, thank you for joining us this morning. Let's start on the Fed then. To what extent are you pulling forward your bets of a Fed cut this year?
Hi, Tom. Thank you so much for having me. I think we saw the U.S. inflation data come in yesterday, and expectations over a Fed cut has increased. The core inflation remained well in line. You also saw the tariff impact, which although a few adjustments were made post the 1st of August with regards to certain countries and the tariff impact. However, you did not see a major pass-through that was expected. About 10-15% of the increase that happened in some of the economies did not have a very direct impact on the core CPI inflation. Again, this is in line with broader President Trump's expectation. The tariff pressure that was on a wider range of consumer goods and services, although not significant impact to deter Fed's, expectations of lowering interest rate. We do expect a space where we will see a significant pressure, even for Fed to have a reduction in the interest rate.
What would the Fed need to see, do you think, Tanvi, to go for a jumbo cut in September?
I think the July data with regards to even the labor statistics that came in, which was a clear sign that showed that businesses were more than ready in terms of passing through the tariff-related cost. I think Fed will have to kind of look at the import products, the kind of impact that will have in terms of raising certain universal tariff that were levied in the earlier session, and how that kind of has a pass-through impact. The labor data, the internal CPI data, you are seeing a sort of a pressure even post the 7th August jump and the tariff negotiations. So I think if everything goes in line, you will have an initial tariff cut, if not a very big jumbo cut in this next session. You are also looking at corporate earning results coming in. So those three impact would be a direct impact on the Fed rate cut.
Let's tie this then to your expertise in terms of your wheelhouse when it comes to India, Tanvi. Does the repricing around the Fed, does it open the door for the RBI? There's always the linkage, of course, between the Fed and what's happening in EM. Does it give the space, or at least additional space, to the RBI to go again with its own cut later this year?
Oh, yes, absolutely. We saw the Indian CPI inflation data also come in yesterday night at an 8-year low. This is well in line with the RBI expectation. We did not see a rate cut in the last MPC meeting that the RBI held, and it was in fact waiting for the inflation numbers to come in. We are seeing Indian inflation numbers to an 8-year low at 1.6% on a year-on-year, which is in line or lower than the broader expectation from RBI. We're expecting a bigger rate cut from RBI and a very direct pass-through as well, somewhere as a broader strategy to kind of lower the impact of the ongoing tariffs with the US as well. The Indian economy on a broader sense has been pushed by the DII investments as well, even though you saw certain FII outflow. The DII did have an investment back into the Indian economy with record highs. So a couple of positive factors in play, even though you're looking at corporate earnings on a muted growth trajectory from Q1. However, with the inflation numbers in check, with the corporate earnings still at a stable level and increased DII inflows, you are looking at RBI sort of have that space to go ahead with a rate cut in line with the US.
To what extent will that offset the 50% tariffs that the US is now imposing on India?
The impact of tariff before, the next round with the president was we were looking at about 0.8% of a direct GDP impact, because even the US is one of the biggest trading partners for India, which amounts to almost 20% of our export. However, the GDP impact in terms of direct nominal GDP, which was about 88 billion to US, would be impacted by 0.2%. However, with the increase in the recent talks, you would expect this to kind of go up. So it's very crucial to kind of see how Fed reacts, the kind of resistance it has, not only in terms of supporting the GDP impact, but also in terms of ensuring that the rupee depreciation does not have that major impact even on its import policies.
Tanvi, just briefly on the equity markets of India, the underperformance that we've seen, certainly versus China since June, unpicking a narrative from earlier this year when we saw those flows into Indian equities, many of those flows coming from not just the US but from China as well. That has reversed. How does that story unfold, do you think, in the months ahead?
To be very honest, Tom, Indian equities did enjoy a premium in comparison to the Chinese market. The Chinese market did have post-COVID, when most of the economies were going through entire rally phase. Chinese economy did have a certain impact in terms of the recovery that they witnessed. And in the similar breath, Indian economy did supersede its, emerging market counterparts. So you did have somewhere a portfolio rebalancing happening even at a private equity space, where money was flowing out of Indian economy towards more, relative valued economies. However, even with the outflows, you've seen Indian economy kind of maintain with regards to equity return on a 20-year perspective, even on a 15-year perspective. The Indian markets have delivered a longer-term alpha in comparison to emerging market counterparts. The Indian household or the domestic investments has somewhere cushioned this outflow of foreign investors. So even though you saw an exit out of the foreign portfolio, the Indian market or the DIIs kind of had about a 1.7% increase in comparison to the exits. So net, you still had a very big inflow from the Indian markets, which is still standing out about 6.5% of the total overall private consumption. So you see the space that the Indian markets do have as well to withstand volatility.
Okay, really smart breakdown and really valuable. Tanvi Kanchan, thank you very much indeed. Head of Business and Strategy at Anand Rathi Shares and stockbrokers on the Fed and the Indian markets as well. To the oil space now. OPEC has forecast a tighter than expected global oil market next year. Tighter than expected, citing accelerating demand growth and slower expansion in rival supplies. More OPEC data suggests global inventories will deplete significantly next year unless the group and its allies revive more halted production. Let's get more with Bloomberg's Middle East energy reporter Anthony Di Paola. Anthony, the narrative had been that this was a well-supplied market, OPEC Plus putting more barrels on the market. The softness in terms of demand from nations like China continued, and yet OPEC Plus sees a tighter market. What stood out to you from their analysis?
Yeah, good morning, Tom. It's true. It depends on who you talk to, whether it's a well-supplied market or not. A lot of the analysts that we're talking to, a lot of the traders say there is plenty of oil in the market, and they are looking at that demand weakening going into the second half this year and worsening the market. But OPEC is maintaining this very bullish view on the market. So they're saying that there really is a need and there's enough demand to take up this oil. So we are seeing some of the demand estimates being trimmed a little bit, but OPEC is also looking at less oil coming onto the market from other producers because we've had this kind of period of lower prices that's discouraging some other production elsewhere. So they're going to see some other oil coming out of the market, not being added from other producers. And we did see also some data from the U.S. EIA showing that crude production in the U.S. was expected to fall next year for an annual decline for the first time in a long time. But still, the U.S. will be over 13 million barrels a day. So that's still a huge amount of production. OPEC Plus, of course, is bringing production back. By the end of September, they will have added 2.2 million barrels a day. Most analysts expect them to take a pause, take a beat, and see where the market is. But they'd like to continue unwinding that into the next year. So we're going to see kind of how that unfolds with that added demand and where the supply picture is, Tom.
Anthony, on the geopolitics and the look ahead to that Alaska meeting between the two presidents of Russia and the US, how sensitive is the oil market right now to what happens at that meeting?
Yeah, the oil market is sensitive. We're seeing oil kind of at a standstill today. We've seen it come down over the last week or so, and it's holding that level just around the $66, $67 mark for Brent crude. But basically, it's looking increasingly like we're not going to get too much out of that because, Trump is even kind of walking back some of the expectations, saying it's going to be a discussion meeting. We are still waiting to see if there's going to be some additional sanctions activity on Russian crude. That was announced by the Trump administration that last Friday would be the deadline, that if there was not some kind of movement or some kind of ceasefire, there would be some sanctions put on. Now we've moved ahead to this Friday, so we're still waiting to see. But, really, I think it seems like the market is waiting to see probably Russian oil continue on the market rather than be sanctioned. Because we are not really seeing strong signs that there are going to be some sanctions coming forward. And then the Russian oil continues to flow. So we'll see whether the sanctions that are in place continue to be enforced very strongly. And, of course, Russia is always finding workarounds in terms of vessels and things like that. We have seen some pullback from some Indian refiners in some of their purchases, but nothing really definitive yet. So, again, that's still a wait-and-see factor. The oil market is waiting. We're waiting for Friday to see if there are any strong signals either way about that will give us some indications of Russian production, Tom.
OK, Bloomberg's Anthony Di Paola in Dubai. Thank you for that update. Staying on the energy space, but switching focus to renewables, because the line's dropping now in terms of the earnings from Vestas. Second quarter revenues coming in below the estimates, 3.75 billion euros for Vestas in the second quarter. The estimates had been for 4 billion euros. In terms of the view on the full year, in terms of margins, they are giving a range of margins of between 4 to 7% expected for the full year. The estimates had been for 5.68%. So at the top end of that range, slightly higher margins forecast. But of course, at the bottom end, you're looking at 4% versus estimates of 5.68%. At the top end, 7% is the forecast. The redhead right now for Vestas, they still see full-year revenue of 18 to 20 billion euros. So at the top end of that range, slightly above the estimates of 19.1 billion euros. Interesting, of course, turbine maker in focus on a week where we've seen volatility in the wind turbine stocks with Ørsted and that rights issue earlier this week dragging on that particular corporate. Coming up, profiting from power. After blackouts across Europe, commodity traders are investing in utility-scale batteries, seeking returns from extreme price volatility. We're going to bring you that story next. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Now, Europe's renewables output has boomed in recent years to help meet, of course, those climate goals. But investments in battery storage have struggled. The problem is that storing electricity and selling when prices are high is much harder than for other commodities. Now, though, a growing number of commodity merchants have started investing in utility-scale batteries, seeking to profit from extreme volatility in European power markets. With the details, as part of today's Big Take, we are joined by Bloomberg's Archie Hunter, who's involved in that Big Take. Archie, thanks for joining us. Talk to us about exactly what utility batteries are and why they're drawing interest, then, from traders and investors.
Thanks, Tom. Yeah, so utility-scale batteries is really all about scale. I'm sure we use lithium batteries for charging your phone or some other aspect. These are really on a massive scale. So they're very simple. I mean, you'll see them. They look like giant freight containers packed next to each other. And yeah, inside them are batteries that can store energy. It's really the huge volatility that we're seeing at the moment that's in energy prices that's driving the interest from traders, and batteries allow commodity traders really to take bigger positions in those markets where we're seeing the influx of solar and wind really transforming the markets. Prices are going negative during the day when the sun is up and it's really bright. Solar's generating a lot of power. So that can mean that traders or the market in general can get paid to take power off the grid, essentially. And then, that can often reverse in the evening when the sun goes down, demand picks up as people return home and cook dinner or watch television or something like that.
Talk to us about why the investments, Archie, are happening now. I mean, how sustainable is this trend that you and the team are seeing, and what is underpinning it? You talked about the volatility in the energy markets of Europe. Is that the key catalyst at this point, and how sustainable is this theme?
Sure. Well, look, commodity traders are interesting because they're for the most part privately owned companies. They're owned by the partnerships that they're head traders or head operational people at those trading companies, and because of that, they've been able to be kind of not first movers, but some of the first movers in this space. So that's why we're really focusing on these companies. They're very interesting in the terms of they've been able to make lots of money over the years, but especially in the recent energy crisis that saw gas and oil prices move heavily when Russia's full-scale invasion of Ukraine happened. And look, they've got a lot of cash to spend. That's certainly one aspect to it. And the other is that costs have come down massively. So, the costs of building battery farms or battery storage sites on a huge scale is now really affordable for most companies. That buying up sort of permitted land and sites where you can do that means that, in the future, if, as is expected, battery costs continue to come down, that will be a good investment to be able to, fill and supply those batteries later on when costs come down further.
OK, Bloomberg's Archie Hunter on the Big Take today, with the details, of course, on Bloomberg.com and on the terminal, the analysis from the team there. Archie, thank you very much indeed. There's a lot more coming up. We're going to give you a breakdown again of the inflation data that's moving markets, continues to move markets. Again, a question mark about institutional risk in the US, with a focus on the BLS and the Fed, and why some of the big tech names in Europe sold off so heavily yesterday. Stay with us. This is Bloomberg.
Next week, Bloomberg is live at the Jackson Hole Economic Symposium, bringing you news and interviews with Fed leaders and other economic experts. Tune in for continuing coverage leading up to a special episode of Surveillance, August 22nd at 9 a.m.
Tech is integrated into every aspect of our lives, from finance to defense, AI to entertainment, and from the road to the stars. Bloomberg brings you the latest stories from the people and companies pushing the tech sector to new frontiers and the politics that shape global tech markets. I'm Tom McKenzie in London. Watch Bloomberg Tech Europe. New episode Friday, only on Bloomberg Television.
Welcome back to Bloomberg Daybreak Europe. So the repricing around the Fed pulling forward bets for September on the back of that more benign picture when it comes to inflation yesterday. In line, even as core ticked up marginally, but the markets coming through with bigger bets in terms of where the Fed lands in September. And you can get to that point as you see this chart working through in terms of expectations, almost 100% priced in by these markets, that you will get an additional 25 basis point cut, or at least the first one of this year, I should say, in September. Markets pricing in around 60 basis points by the end of the year. And of course, the US Treasury Secretary, Scott Bessent, hinting, suggesting, nodding to a jumbo cut as well, saying that should be in play. 50 basis points, according to Bessent, should be in play for this Fed. Let's flip the board and have a look at the dollar at a time when our team at MLive are putting a spotlight on the institutional risk around the US, given the pressure on the Fed, given the pressure on Jay Powell, once again coming through from the president yesterday, and given, of course, the changes at the top of the Bureau of Labor Statistics with the nominee, E.J. Antoni, having suggested that you could do away with that monthly jobs report. Is there an institutional risk now? And what does that mean for the dollar as you think towards the end of this year around those changes and into 2026 with the change at the head of the Fed? That is something being flagged by MLive. You could see further weakness in the dollar on the back of that institutional risk and question marks there. The call, at least from some of our team. Let's flip the board and have a look at how the AI story unfolded for some of the European tech stories yesterday. The hit around SAP. That stock dropping more than 6%, close to 7% by the end of the close. Sage here in the UK as well, taking a knock of almost 5%. As some start to question the AI impact on some of these legacy software companies, this following downside pressures on the likes of US companies like Monday.com and C3 AI on Monday as well. So those question marks leading to a significant sell-off yesterday. Will that be reversed today or continue? We continue to watch those stocks. Bloomberg Terminal subscribers, by the way, getting all these charts, of course, on the terminal. There's plenty more coming up. The opening trade is next. This is Bloomberg.